afternoon, everyone. Warm welcome to this panel discussion. As you know, this is being organized by the ITAC Center for Public Policy. This is a relatively new center in Ashoka University, and our main purpose, essential purpose, is to provide or improve the policy environment for policy making. We have various activities, one of them being organizing discussions of the kind that we are going to have today. We also have a website where we publish policy briefs, case studies, longer research articles, and we also have an active educational component. So Ashoka University, the economics department, will be starting a new interdisciplinary major on economics and public policy starting from next academic year. We'll also have various executive education programs, the first one being later this month in Mumbai. We have, as you can see from the program, we have a very distinguished panel of speakers. The main moderator is Mr. Vivek Johri, who will introduce the other speakers. So let me just mention a couple of words about Mr. Johri. He's had a long and very distinguished career in the government of India, and he retired as the chairman of the board of indirect taxes fairly recently. And we hope that Mr. Johri will contribute. He's actually going to write, or he's almost about to finish, writing a case study for us on GST, with which he was very intimately involved. And we hope he will continue to play an active role in the workings of the center. I don't want to take up any more of the time. I'm sure you've come here to listen to the panelists and not to me. So I'll request Vivek to take over. Thank you.
Thank you, Professor Datta. Very good afternoon to all of you. And it's a great privilege and a pleasure to be here this afternoon to moderate this panel discussion. As you know, the 16th Finance Commission was set up end of December with Shri Arvind Panagaria as its chairperson. He was the vice chairman of NITI before he took up this assignment. Then a full complement of members was appointed on the 31st of January, exactly a month later. And the commission is expected to submit its report to the government by October of 2025. And the award period is, as always, 5 years, starting 1st of April 26. We'll talk in some detail about the terms of reference of the commission. There's been quite a lot of commentary, on the way the terms of reference have been drawn up this time. And I'm sure the panelists would have something to say to that. But today's panel, let me begin by introducing the panel. I think it's a Dream 11 team for public finance. I mean, you have the best names in public finance assembled here today. And let me begin by introducing Professor Sudipto Mundle, who's the chairperson of the Center for Development Studies. He's a non-resident senior fellow at NCAER. Formerly, he was an emeritus professor at the National Institute of Public Finance and Policy at New Delhi. Also a member of the 14th Finance Commission. In fact, the panel has 3 persons who are very closely associated with earlier finance commissions, and we can draw on their experience this afternoon. He was also a member of the Monetary Policy Advisory Committee and, of course, the chairperson of the National Statistical Commission at one stage. So he spent a long period with the Asian Development Bank at Manila, and prior to that, he's done assignments at the Indian Institute of Ahmedabad, Management at Ahmedabad, the Center for Development Studies at Trivandrum. He's been a visiting professor at Yale and Cambridge. So welcome to you, Dr. Sudipto Mundle. May I invite you to join us on the dais, please. Next, we have Professor Govinda Rao, who we all know as the head of the National Institute of Public Finance and Policy, which he helmed, I think, for 10 years, if I remember right, 2003 to 13. Dr. Rao he was a director of the Institute for Social and Economic Change. He's also worked in a number of advisory roles. As I mentioned earlier, he was a member of the 14th Finance Commission. He was a member of the PM's Economic Advisory Council, as well as a member of the Financial Sector Legislative Reforms Commission. Dr. Rao has done a tremendous amount of work in the area of public finance, and I keep lamenting to him that we don't have enough public finance economists in the country. He's just ended up writing, I think, the second version of his book, which is called Studies in Indian Public Finance, and I would urge all of you to go through it. It's quite a good, comprehensive account of where we are with our public finance. Next, we have Professor Poonam Gupta. She's the Director General of the National. I request Dr. Rao to please come on the dais. Thank you. Professor Poonam Gupta is the DG of the National Council for Applied Economic Research, NCAER, and as well as a member of the PM's Economic Advisory Council. She is editing 2 journals. I don't know how she finds time to do that, but she's editing 2 journals, Margin and Indian Policy Forum at the NCAER. She's also the founding director of NCAER's National Macro and Growth Center. And she's worked before that at a number of multilateral institutions, including the IMF and the World Bank and IFC. She taught initially at the Delhi School of Economics and the University of Maryland in USA. Her focus areas have been issues related to international financial architecture, economic growth, monetary and fiscal policy frameworks, structural reforms, and state-level growth dynamics, among others. She's edited a book on India and China with Barry Eichengreen, and she's been writing columns for many newspapers and dailies, including the Business Standard. Welcome to Professor Poonam Gupta. May I request you to join us on the dais, please? And then we have finally Professor Pinaki Chakraborty. He's a former director of the National Institute of Public Finance and Policy. He played a very key role in advising the 14th Finance Commission as their economic advisor. He spent a long time with the UNDP, working in some African countries, Nigeria and Kenya. And he's worked with the Kenyan Commission on revenue allocation in reviewing its first-generation formulation of revenue allocation. His interest areas are fiscal federalism, tax policy, and resource mobilization, applied macroeconomic, public expenditure management, decentralization, and gender and fiscal policy. May I request you to join us on the dais, Professor Chakraborty. Thank you. So before we begin the discussion, let me share with you what you can expect over the next hour and a half. So to begin with, we will open the floor for the panelists to make their opening remarks, preferably about 10 minutes each. Some of them have preferred to use a PowerPoint presentation, which we'll request them to go through. And this will be followed by a discussion for about another 50 minutes, and then a Q&A session. What I thought, and I think I have the consent of the panelists in adopting this format, is that we'll begin by discussing the broad macroeconomy, because that is what provides the setting for any finance commission, and that's what is going to determine where the resources are going to come from. So we'll begin with a very brief discussion on the macroeconomic parameters. We'll go into the health of the fisc, both the center and the states, and thereafter we'll get into the nitty-gritty of the 16th Finance Commission, what the terms of reference are, and what are the key issues that we expect them to look at. So that very broadly is the lie of the land for this panel discussion. Thank you very much. And may I now request Professor Sudipto Mundle to make his opening remarks, please. Thank you.
Thank you, Chair. I should also begin by thanking Ashoka University and in particular Professor Datta for inviting me to this very timely panel. I should just mention at the outset in your introductions, one point worth noting is that all the 4 panelists have actually at some time or another spent a long time at the National Public Finance and Policy, 2 of them as directors and Poonam and myself as professors there. I have made some notes which I'm going to present, and if I run out of time, please just stop me. So let's see how far I can go. But as you said, you wanted to start the discussion by looking at the state of the economy and the fiscal situation about the states. I won't have much to say except that right now the economy, as everybody says, is one of the fastest growing major economies in the world. It's been doing pretty well, 6.5% growth according to some forecasts going forward. Inflation is a little bit above the target 4%, but still well under control right now. So the macroeconomy is doing well. Of course, the external environment is pretty bad, as we all know, with 2 wars still going on. But domestically, we've not been doing too badly. On the fiscal situation, I think the central government, it has been characterized by trying to work very hard at bringing down the fiscal deficit. It has been doing that in the last couple of budgets after the big shock that put everything out of kilter with the pandemic. As far as the states are concerned, I think there's a huge variation across states, and that is worth keeping in mind, that some are in a very healthy situation, others are in a troubled situation, and so on. So that's all I will say by way of background. And then let me go right down to talking about the 16th Finance Commission and the issues before it. There are a whole range of issues that the 16th Finance Commission will have to grapple with in its deliberations, of which I have selected only 5 for brief remarks. And these are as follows: fiscal marksmanship, the tension between the principle of subsidiarity and the compulsions for centralization, measures to supplement the resources of local governments, the demographic factor in tax devolution, and time permitting, I'll also say something about coordination between the Finance Commission and the GST Council. So starting with fiscal marksmanship, macroeconomic forecasts play an important role in the design of many economic policies. They have a particularly critical role in the context of tax devolution and the determination of revenue deficit grants. The 16th Finance Commission will have to base its computations of tax devolution and revenue deficit grants on forecasts made by, let's say, July of next year, 2025, but for a period going up to the financial year 2030-31. However, making reliable forecasts for more than 1 or 2 periods ahead is actually very challenging methodologically. Those of you who are in the business of forecasting will already know this. And forecasts for a period of up to 5 or 6 years going forward, which is what the Finance Commission will have to do, are likely to be quite fragile. In fact, poor fiscal marksmanship has been the experience with tax revenue projections for most finance commissions in the past. It is not surprising given the nature of the requirement. Now, if the projections of actual revenues are higher than the Finance Commission projections, this is not much of a problem. It gives more elbow room to both the central government and the state governments. However, if actual revenues turn out to be less than the projections, then this puts the central government as well as the state governments under fiscal stress. For the state governments, the actual flow of tax devolution transfers from the center will be less than what has been projected. At the same time, their own revenues will also be less than what has been projected. And the revenue deficit grants fixed by the Finance Commission will also therefore fall short. They will then have to either drastically compress expenditures to maintain the desired fiscal deficit target or undertake excessive borrowing, which could exceed permitted limits under their respective FRB, that is the Fiscal Responsible Budget Management Acts, and possibly drive them into unsustainable levels of debt. For the central government, tax devolution transfers are set as a proportion of the shareable pool of central taxes, and these will be calibrated down in line with the shortfall in the shareable pool. However, the revenue deficit grants awarded by the Finance Commission are fixed, and these transfers have to be provided despite the shortfall in revenue. This will then push the central government, along with other stresses of the shortfall, towards either cutting back its expenditure or to make its fiscal deficit targets, to meet its fiscal deficit targets, or undertaking excessive borrowing, exceeding its FRBM limits and incurring excessive debt. Hence, if the 16th Finance Commission can commission some quick methodological research to ensure more robust revenue projections than those recorded by earlier finance commissions, I think that would be a most welcome development. Next, I talk about the tension between subsidiarity and the compulsions towards centralization. The second issue is the tension between subsidiarity and the compulsions for centralization. The principle of subsidiarity maintains that decision-making is most effective when the deciding authority is as close as possible to the constituents affected by the decision. For example, the state government. Decision-making should be delegated, quote unquote, to higher jurisdictions only if the effects of the decision spill over to constituents of other jurisdictions. In other words, higher levels of government should be assigned a subsidiary role. National public goods such as defense or security cover the whole country and of course need to be provided centrally. The same applies to maintenance of macroeconomic stability, interstate river systems, or issues of climate change and the environment that cut across state boundaries. But that apart, economies of scale could imply that for certain goods or services, systems costs are minimized when they are provided on a national scale. Examples would include a power grid, a gas grid, or other nationwide infrastructure systems. Also, the principle of equity requires that certain public services such as education and healthcare, or merit goods such as subsidized food, should be provided on a comparable scale across a national tax jurisdiction, irrespective of the fiscal capacity of individual states. These considerations call for centralization. The assignments of subjects under the Union list, the States list, and the concurrent list in the 7th schedule of the Constitution was the balancing path our founding fathers laid out to help us navigate our way between the competing compulsions of greater centralization and decentralization. It has been argued that the 7th schedule did not give adequate weight to the externalities that call for greater centralization, and that the assignment of subjects in the schedule need to be revisited. Any such reassignment of subjects in the 7th schedule will require a constitutional amendment and obviously cannot be undertaken by the 16th Finance Commission. However, the Commission needs to tread very cautiously even in discussing the matter, since it is a very sensitive political issue. Many states, especially the states with non-NDA governments, have complained that the center is encroaching into the constitutional space of the states using the instruments of centrally sponsored schemes and other means. And I should mention that when the UPA government was in power, the same complaint would then be made by the non-UPA-led state governments. I now turn to my third issue, measures to supplement the resources of local governments. The third issue is that of supplementing the resource of local governments, Panchayati Raj institutions in rural areas, and urban local bodies like municipalities in urban areas. The principle of subsidiarity discussed earlier in the context of center-state relations applies equally, if not more so, for the third tier of government, since it is the local governments which have to provide essential services such as drinking water, sewage and sanitation, local roads, fire brigade, street lighting, etc. The Constitution has mandated the finance commissions to recommend measures to augment the consolidated fund of the state governments in order to supplement the resource of local governments on the basis of recommendations of the state finance commissions. However, some states do not even appoint the state finance commissions regularly. Even if they are appointed, their recommendations are sometimes ignored. Grants provided by the National Finance Commissions, especially earmarked for local governments, are either not passed on or passed on with much delay, thereby preempting their effective use. Does that mean I should stop?
No, please carry on. But yes, time is up.
The usual explanation offered is that local governments lack the capacity to provide these services effectively. While this is true, it is difficult to see how their capacity can be strengthened if they do not have the resources to do so. Of course, in fairness, it has to be said that most local governments have also not adequately used the tax handle they do have, such as the property tax, to augment their own resources. The fact is that state governments have little incentive to pass on earmarked finance commission grants to local governments. Indeed, state legislators see the empowering of elected local government officials as inimical to their own interest. Recent finance commissions, especially the 13th, 14th, and 15th, have struggled with this mandate. If the 16th Finance Commission can find a way to adequately incentivize the state governments to pass on grants earmarked for local governments in a timely manner and invest in strengthening the capacity of local governments, it will have achieved, in my view, a major step forward. Next, I turn to the fourth issue, which is the demographic factor in tax devolution. Population size of a state has been an important component in the tax devolution recommendation of finance commissions, especially all the commissions of this century. The 12th Finance Commission jacked up its weight in the devolution formula to 25%, up from 10% earlier. The 14th Finance Commission raised it even further to 27.5%, and that has been maintained by the 15th Finance Commission. However, there are important changes underlying these overall changes in weights. All finance commissions appointed since the 71 census up to the 14th Finance Commission, were required to use this census as a demographic base for the odd reason that the 1971 population base is still the basis for delimitation of constituencies in elections. However, the 14th Finance Commission was allowed to take into account subsequent demographic developments and took advantage of that provision in its terms of reference to assign a weight of 10% to the 2011 census, in addition to the 17.5% weight it assigned to the 1971 population. The terms of reference 15th Finance Commission asked it to use the 2011 census as its population base. While doing so, the 15th Finance Commission also assigned a weight of 12.5% to demographic performance, in addition to the 15% weight assigned to the 2011 population base of states in its horizontal devolution formula. Now, demographic performance essentially referred to reduction in total fertility rates, and it was incorporated to respond to the concern of states where fertility had declined significantly. They argued that in using the larger population base of 2011, the Finance Commission would be penalizing them for having successfully reduced population growth. The demographic performance variable was introduced to offset that disadvantage with the 2021 census having been postponed. Further large change in population shares are likely to have occurred in the 15 years since the last census of 2011. The 16th Finance Commission will need to address this issue, perhaps by a further reallocation of weights in favor of demographic performance based on the latest available state fertility data. I now have my last point. May I continue?
Yeah, please.
Yeah. Okay, so my last and final issue is about coordination between the Finance Commission and the GST Council to address their intersecting domains. The GST Council makes all decisions regarding rates, coverage, exemptions, etc. with regard to the goods and services tax. However, the state GST or SGST is a major component of the own tax revenue of states. Similarly, the central GST, if not the IGST, is now a large component of the central government's indirect tax revenue. Hence, what assumptions should be made for projecting states' SGST revenues and the center's CGST revenues in the absence of coordination arrangement between these two constitutional bodies. This became a major concern during deliberations of the 15th Finance Commission. However, it seems to me that this concern was perhaps unwarranted. Even if a coordination arrangement was in place, the GST Council itself would not know what rates would prevail 5 years down the road. Besides, even before the GST was introduced, changes in the indirect tax rates of the centre and the states were made in the respective annual budgets, just as can happen with the GST Council now. Buoyancy projections for indirect tax will thus be subject to similar error margins now as in the pre-GST regime. There is therefore no additional uncertainty arising out of the introduction of the GST and the GST Council. With this, I conclude my remarks. Thank you.
Thank you. So thank you, Professor Mundle. I think you've already hit the core of the mandate that the Finance Commission is expected to look at. You raised the issue of vertical and horizontal equity, how they're going to be resolved, this perpetual conflict, which every Finance Commission, I'm sure, has to deal with about how to balance. And most of the time, they find a way out. Whether it's acceptable to everyone or not is another issue. And of course, there's this big question of what would be a credible basis for the data that the Finance Commission uses during its deliberations. So thank you very much for your opening remarks, and I'm sure we'll delve deeper into the issues you've raised. May I now request Professor Rao to make his opening remarks, please.
Thank you, Mr. Johri, and let me at the outset thank Center for Public Policy and of Ashoka University, and particularly Dr. Bhaskar Datta, for inviting me to this very interesting session on the issues and challenges before the 16th Finance Commission. It's commendable that he has been able to put together, get a number of people, perhaps with different points of view, but nevertheless. An important issue that we all in federalism literature look is the clarity in assignments. It's like Coase theorem. It's like giving property rights. Clarity in assignment is critical. And the other important thing, a major thing in implementable rule of fiscal decentralization is assignment according to comparative advantage. Now, if you combine the two, then what happens is that obviously you get a vertical imbalance, because union government, I avoid the word central, union government always has a comparative advantage in raising revenues. And subnational governments have the advantage in undertaking expenditures for whether subsidiarity reason, or whether a lot of diversity in the country, and then obviously diverse, to provide public services according to the diverse wishes of the people. Now, the moment that happens, as I said, there is overlapping in the assignment system between revenues and expenditures, and Finance Commission come in. In many of the times when you have these conflicts, Coasian bargains don't always work. But basically, the Finance Commission is there to try to work out some sort of a bargain. The role of the Finance Commission is to assessment of revenues and the need revenue capacities and expenditure needs of the states. Now, if you have a perfect matching of revenues and expenditure, the only reason why you need the transfer is the differences in fiscal capacity. Now, that comes from the seminal paper by, on horizontal equity grounds, seminal paper by James Buchanan way back in 1950, in the American Economic Review. But anyway, the point is that so you have to resolve the whole issue of overlapping assignments. Again, if you look at the federalism literature carefully, macroeconomic stabilization and redistribution are predominantly the functions of the union government. It's in allocation of resources that because even in redistribution, if the states start redistributing, then what happens to all the poor people? No state would like to deal with the poor people because they don't want more poor people to come in. But anyway, they're predominantly, not exclusively, the functions of the union government, which basically means, sort of, there is this tension between revenues and expenditure assignments, and the commission has to come in and resolve this issue. Now, there is a lot of confusion whether what is the function of the federal transfers. Federal transfers are not meant to achieve regional equalization. Now, convergence depends upon resource endowments, private and public investments, and nature of institutions in different places determining the structure of incentives. And therefore, everything cannot be done by the transfer system. It only deals with the public government expenditure, but in the case of Finance Commission, only the revenue account, sort of expenditure. And again, general purpose transfer is meant to enable the states to provide comparable levels of services at comparable effort. And specific purpose transfers are given to ensure a minimum standard of service. This distinction is very important. Ensuring minimum standards of services through specific purpose transfers. If you really ask a question whether your centrally sponsored schemes really try to ensure a minimum standard, I don't think in any centrally sponsored scheme they have said that this is the minimum standard. Anyway, that's another question. What is it that the Finance Commission is supposed to do? It's an important institutional mechanism for general purpose transfers. It has to deal with vertical and horizontal imbalances. Mandate of the Finance Commission is given in Article 280, subclause 3, which is tax devolution, grants in aid. And then the third one is, I emphasize the word, measures to augment the consolidated fund. It is not augmenting the consolidated fund. Measures to augment consolidated fund of the state to supplement the resources of local bodies based on the recommendations of the State Finance Commission. Finance Commission don't have to give grants. They just have to recommend measure. But then they have been giving. That's a different issue. But it's the Constitution basically says it is supposed to be they have to recommend the measures. And then any other matter, but under, for the 16th Finance Commission, so far, I say so far, under any other matter, nothing has been, given. So then that does not mean that it cannot be given later. The terms of reference, later on you can add the terms of reference, you can give the terms of reference. But nevertheless, they have to look at the macroeconomic situation. They have to see how much of a fiscal space exists for giving to the states. And, obviously much of the work that has to be done on the macroeconomic side. What are the challenges before the 16th Finance Commission? Let me just summarize these. One, not giving detailed terms of reference has its advantages, gives greater flexibility and autonomy to the Commission. However, due to the difficult fiscal conditions today, the degree of freedom to the Commission is limited. It can avoid now, that's because after the COVID, you have a very high level of debt. It went up to 90%, now it is about 83% of the GDP. Now, under this, condition, how much of, flexibility do you have to give more, to the states? And that's something, and then, again, you can say that, oh, I have made the assessment of the center, and the center can give so much to the states, but that doesn't make much of a difference. Once Guhan, one of those person who said, Finance Commission can only bark at the center, but they bite the states. This is something to be, that So they can't discipline the center. There is no way they can discipline the center. And if the commission comes up and says that you have a fiscal council, the union government will say, go climb the tree. I don't care. So, obviously there is nothing that can be done. Now, you can say in the paper that it's an impartial body. It has to basically look at both the union and the states in the same manner and all that. That just doesn't exist. It's a battle between the unequals. The 16th Finance Commission is appointed at a difficult time. The earliest fiscal adjustment target, now we said that there should be 3% of GDP for the union, for the 3% of the GDP for the fiscal deficit target, and overall debt limit should be 60%, etc., etc. That no longer holds. First, one thing, it's not easy to get. Second thing is, even that 6% that you have arrived at is on the experience that household sector saving was 10% of GDP. Today, household sector saving is 5.1% of GDP. So, which means that you will have to have even a tighter target. Now, so, the issue is much more difficult there. They have to really deal with this particular issue. The states are in a bad shape, partly due to unrealistic projections made by the previous Finance Commission. See, there was one item in the term of reference in the 15th Finance Commission which said, please see whether revenue deficit grant should be given at all. So what the Finance Commission has done is, they have done the projections in such a manner that by the end of the terminal year of the Finance Commission 25-26, no general category state is left with any revenue deficit. All the general category states are balancing. How did they do it? They drastically reduced the expenditure growth. They increased the revenue growth and phased it out. Now, so much so that even the interest payments, which are usually taken at the actuals, they have estimated the interest payment growth at 9% for everybody. Now, whatever means your actual interest is not taken. In this particular circumstance, now so most of the states are having serious problems. What happens is that now you are giving loan for them to do the capital expenditure. To that extent, they are able to do the capital expenditure. But the point simply is that many of the states are severely stressed. Of course, some of them have gone to the court. I don't want to go on that. So the projections are unrealistic, and that can create, from there, now how do we start? Would the new commission say that we will also not have a revenue deficit target? Or what is it that it's going to do? We don't know. The commissions will have to decide on its own methodology. How can it make the system incentive compatible? This is another issue that comes up very often. There are two problems with the Finance Commission's recommendation. I call them, one is tyranny of the Bezier, and the second thing is fiscal dentistry. Tyranny of the Bezier comes because you basically take the Bezier numbers and then make projections. The states which have low levels of per capita levels of expenditure are destined to, are condemned to have low levels continuously, because you are basically starting from a low base. However much a growth rate you do, again, you don't really give a very high growth rate to them. So you have a tyranny of the Bezier continuing for some of the poorer states. And fiscal dentistry is, you make projections of revenue, projections of expenditure, and then give the tax devolution numbers. The gap that is filled in, the cavity that remains is being filled every time. So the cavities become larger and larger over a period of time. So obviously, this is a work in progress. They have been using norms, but still that basic problem remains. So how are you going to deal with this issue? How do you make the system incentive compatible is an issue. Now, how do you really deal with another big elephant in the room? That's called the centrally sponsored scheme. Now, that has been one of the biggest, elephants in the room, because centrally sponsored scheme, the total the total transfer, the current transfers made by the union to the state is somewhere about 50% of the central revenue. But what happens is that if the tax devolution is increased by the Finance Commission, but that year they reduce the grants, but the next year they will have more surcharges so that they can retain the money and then give more centrally sponsored schemes. The grants after the 14th Finance Commission increased the devolution. The grants immediately went down, but then now it has become the grants. The central grants have become the centrally sponsored grants have become much larger. As I mentioned, these are specific purpose grants. None of the specific purpose grants mentions what is the minimum standard that it wants to achieve, because the objective of the specific purpose grants is to ensure a minimum standard. You don't see them. There are 28 of them umbrella grant, central schemes. Then actually, if you see, there are several of them. Even in the case of education, Sarva Shiksha Abhiyan, there are 26 different components, and each state is required to prepare the components separately, and that has to be approved, and it has to be, and then if the state wants to change, it has to seek the permission of the center. I mean, there are quite a few other problems there. So, how do you safeguard the state shares? In this particular situation, is one good thing that has happened is, thanks to Johri, the GST is becoming more and more buoyant. And I have been saying this for quite some time now. In many countries, GST is basically a money machine. And that's what McKean says. So obviously, GST can help to a considerable extent, and it will continue to be, the compliance will continue to improve, and that can, but then, along with the GST, income tax also is likely to increase. The reason is that there can be a matching between the GST and income tax. On the local body grants, I have just one point to make. All the finance commissions make conditions, and this finance commission 15th, except the 14th, also has given conditions. Now, all these conditions have to be fulfilled by the state governments for the local bodies to get the money. And the state governments have no interest. Now, what do you do? So, this is one of the major problems. Now, the commission has said that, has given an entry-level condition that by the March end of 2024, all the states should have a state finance commission's report so prepared and accepted, put in the legislature. I don't know how many of them have. Now, the question is, how do you really, make, there's basically a major problem there, because entry 5 of the state list says, the local bodies is a state responsibility. And then you have 73rd and 74th Amendment, which says that, local bodies are given, so are supposed to act as local self-governments. So there is a major conflict there. And interactions with the GST Council, I just want to say this. Both of them are constitutional bodies. Since both of them are constitutional bodies, getting information on GST Council itself can be a problem. In fact, 15th Finance Commission had serious problem getting information from the GST Council. Not only that, the Controller and Auditor General had problems in getting in the GST data. In fact, they complain about this. Now, how do you really go about this? It is something which needs to be seen. And the final thing that I say is, how can you, with all the things that you have, when you say states and union and all that, states have, by and large, in aggregate, adhered to the fiscal deficit targets. By and large, they have adhered to the revenue deficit targets, except in the year of this thing. Union government has not. Now, how do you bring union government to discipline? That's a point which I made earlier. You can bark at the center, but you can only bite the state. Thank you.
Thank you, sir. Thank you, sir, for, I think, some very candid comments. Of course, the level playing field is being discussed in other contexts quite often in the media these days, but you raised the issue of the level playing field between the union and the states. This is a question I had for later, but you already have a view on what an open-ended terms of reference of the Finance Commission mean. I think your interpretation is that they have almost a carte blanche for doing and interpreting their methodology, their the issues that they want to go into. They have a freedom to do that. And lastly, I think the very important point you made is that the degrees of freedom are quite limited for the Finance Commission, given certain parameters that you flagged. Thank you very much for those inputs. May I now request Professor Poonam Gupta to make a presentation?
Thanks to the organizer. So when Alok asked me if macro could go first, I thought he was talking about me. So what I'm going to do is doing macro. And so the audience will have to just rejiggle the presentations in their mind and we'll all be good. So what is it that I'm going to be talking about? These were the prompts I had agreed to. Some of these have already been mentioned. I'll add more color to it and hopefully a little bit of a framework to it so that we all are on the same page despite being the third speaker of the panel. So state of the economy, state of India's public finances, heterogeneity across states, some issues for the Finance Commission. I'm a macroeconomist by training and practice. Public finance is something I do as a moonlighting exercise, but it's turning out to be really very, very interesting. Some members of my team are sitting out there, and we are trying to find fun in issues as drabby as those related to the Finance Commission. So let's see what we have to do here. So GDP growth actually in India has accelerated over the long-term period of the last 3 decades. What we have here are the decadal averages, annual averages. We have singled out the COVID period as being an aberration, and growth has resumed post-COVID. This year is predicted to be, the last year that we just completed, 23-24, is projected to be really good at more than 7.5%. And the current year is also, early projections show will turn out to be close to 6.5 to 7, but let's see how the year actually turns out to be post-election. What is even more remarkable is that India's population growth rate has been slowing quite rapidly, actually. These are projections as well for population growth rate, which means that the acceleration in per capita income levels has been faster than that in the GDP. And this distinction really matters. As a part of my research program, my colleagues and I have been looking at the state diagnostics, drivers of growth across states, how well they are catching up with the national economy or not. And there we find that at least in per capita income levels, both the numerator and denominator have mattered. Economic growth rates certainly differ across states, as do the population growth rates. And that can make a difference for some of the states. For example, Bihar is a very high population growth rate. And therefore, despite growing at a reasonable number, its per capita income growth rate does not show all the progress it has made compared to a state such as Orissa, whose population growth rate actually is slower than that of the national average, which compounds the growth rate in GDP and results in a quite rapid increase in per capita income growth rates. These days, most market analysts talk about the high-frequency indicators. Most of them are available at monthly frequency, a handful at daily and weekly frequency, and a very small subset at quarterly frequency. So when we are looking at the Indian economic growth outlook, we look at these high-frequency indicators, and we put them into 2 columns, those which are showing buoyancy and those which are either mixed or show some weakness. And the list of the variables which are showing overall economic buoyancy has been large. over the past 1 year, and it has remained large. So on the right-hand side, we struggle to find variables to put. These are all, as I said, high-frequency macro variables, and often, and the list hasn't changed, mixed indicators of employment. And this morning, I added quality of employment because I don't know much about it, and the list was looking very, very small. Besides the growth rate in GDP and growth rate in per capita income, another macro narrative of the Indian economy is its increased resilience, that there is not just macroeconomic stability, there's some kind of resilience to the GDP growth numbers as well. And in a full-fledged macro presentation, I explained why this increased resilience is sounding like a reasonable outcome. And there I single out a number of shocks that have in the past impacted the Indian economy and how their role and their contribution has been declining to making GDP growth volatile. So, for example, the price of oil. India remains an oil-dependent economy, an economy dependent on which depends on imported oil, but the dependency has been declining. The GDP intensity of oil has been declining, which means a similar price shock does not impact the economy as much as it used to. So, today I read that oil prices have increased to $90 a barrel. First, these are in current dollars. So in real dollar terms, that increase is much less than it would have been, let's say, 5 or 10 years ago. Second, the Indian economy has become much larger compared to the import of oil, which means it's less of a story today than it used to be. Similarly, rainfalls do not impact the Indian economy as much as they used to. Given my short presentation on macro, I am not showing evidence, but my full-fledged presentation has evidence on each one of these points. Capital flows reversals, at least for now, have really stabilized. Portfolio flows have been quite good to the economy. Global risk factors are less important this year and are likely to remain so. And so that is not an issue either. And there is political or policy certainty. The days of hung parliaments or midterm elections seem to be fewer now, and which has given some kind of environment of political and policy uncertainty. Alongside, there is macroeconomic stability. So I talked about growth. When we talk about macroeconomic stability, we generally talk about the kind of variables we have on this slide. Current account deficit is only 1 to 1.5% of GDP. For a fast-growing emerging market, it's a very low and comfortable level of current account deficit. Generally, for an economy like India, a current account deficit of 3% of GDP is considered to be safe. Compared to that, India only has 1 or 1.5%. Inflation has been more than 4%, but really very, very range-bound at 5%, and it has become less erratic during the last few years. And in fact, I relate it to the adoption of inflation targeting. Financial sector has been cleaned up. Non-performing loans are low. Credit growth is very, very high. Not just the private banks, but public sector banks seem to be doing relatively better than in the past. As far as the external account is concerned, I mentioned there is stability on capital inflows level, forex reserves are increasing, exchange rate is rather stable, and so on. But what about the first bullet point there, which is fiscal deficit and public debt? Dr. Rao mentioned these are very high and they remain very high. In another full-fledged presentation that we have, we talk about India's sticky fiscal outcomes. What do I mean by that? As a part of a research paper we had done at NCEER, we look at India's general government public finances. And there we find, again, repeating what Dr. Rao said, India's fiscal deficit has remained higher than 7% of GDP for most of the past several years. During COVID, of course, it increased to multi-decade high. But it has been very, very hard to bring it down to 6% of GDP ever. Tax revenue to GDP ratio has increased only very, very slightly. Despite everything that we read about, the tax buoyancy as far as the GST goes, tax revenue to GDP ratios has increased slowly in India, and future might be different, but let's see whether that's going to be the case. Non-tax revenue to GDP ratio for the general government have been really pretty much stagnant. And so that constrains the spending space as well. Total expenditure to GDP ratio has been steady, but there has been a very, very welcome increase in the allocation of total expenditure towards capital spending, which is great. General government, because of its very high level of public debt, which I have here, spends nearly 5% of its GDP in interest payments. So general government public debt increased to 90% during COVID, is inching down very, very slowly. But the projections show that it's unlikely to come down to the pre-COVID level anytime soon. So is this a very high level of public debt? Should we be worried about it? If it was some other emerging market, it would have been really worrisome. It would have perhaps resulted in some kind of a reaction from the markets, maybe some more rating downgrade, maybe some impact on the exchange rate. But in India, we have macroeconomic stability, which means none of the above, which coincides with such a high level of public debt, and is primarily because of the way this public debt is financed. Almost all of it is domestic. Almost all of it is long-term. Almost all of it is in local currency and on fixed rates, which means that there are very little surprises with the financing of the public debt or any market reaction for all of those reasons. There are other reasons why this public debt has been manageable so far. Those two reasons are capital controls. The government mandates actually most of the institutional investors to hold Indian government debt as a safe asset rather than an external debt, and adequate domestic savings that Dr. Rao mentioned may decline or have been declining. So should we be worried about this high and elevated level of public debt despite there being no risk of macroeconomic instability or a market reaction? Certainly, and the main reasons are really twofold. One is high interest payments, which leave less room to spend on capital expenditure. And second is household savings may not turn out to be as comfortable as they have been in the past. Now, let me come to, in the next 2 or 3 or 4 minutes, whatever time I'm allowed, to talk a little bit about the heterogeneity across states that we are seeing in our work and some issues for the Finance Commission. So when we talk about different states, the fiscal situation of different states or the level of public debt and how comfortable they are, we do see different states being at different levels or different quality of their public finances. I have listed 2 of the extreme examples here. Gujarat has a low debt to GDP ratio, and under most scenarios in our debt sustainability analysis, this ratio is going to decline further. At the other extreme, of course, we have Punjab, a state we read about a lot in the press, which has a very high debt to GDP ratio under most scenarios, except for the most benign one where we assume that it will grow much faster than in the past and it will bring down its primary deficit by a large account and it won't have contingent liabilities. That's the only scenario in which its debt to GDP ratio declines. In a business as usual scenario, that its growth rate and primary deficit will remain at the levels that we have seen in the last decade, its debt to GDP ratio will increase. So we have also done some analysis looking at the changes in debt to GDP ratio for different states over the past decade, and we divide them into above median and below median, and we try to find correlates of what explains this differential performance of the states. We find that the states with higher primary deficit and higher contingent liabilities are the ones which have experienced larger increases in their debt to GDP ratios. So there is something to think about that. Now, my last couple of slides on India's fiscal federalism, just to give some basic numbers. Again, being the third speaker, I cannot avoid repeating what others have said before me. Center collects 2/3 of the total revenue, and it incurs 1/3 of the total expenditure. States collect 1/3 of the revenue themselves and spend 2/3 of the total expenditure, which means nearly 1/3 of the total revenue is transferred by the center to the states. And the three ways it is done. One is tax sharing, which is, how do I go back to my slide? Page down? No. So, page up, yeah. So, out of the total that is transferred, which is a little less than 7% of GDP every year, nearly half is tax sharing by the center through the Finance Commission. Dr. Rao mentioned that point, a point that is forgotten often. A very large percentage of these revenues, these resources are shared by the center through centrally sponsored scheme. And Isaac Center may want to have a one panel discussion just on that. You know, we get all excited and hyped about the Finance Commission when a large amount of resources are being transferred through these schemes, and only 0.6 percentage point of GDP through the grants. Again, grants as a macroeconomist is an area which I would say not necessarily worth my time. I'll focus on the top two. Tax devolution criteria have evolved only a little bit. Population does get a very large weight, as does the income distance. So what are the kind of states which benefit through that? Poorer, populous states. Bihars and UPs benefit at the expense of some of the leading states over and over again. And so these are the shares of taxes recommended by the 14th and 15th Finance Commissions across states, and you do see persistence. Though there are some smaller changes, these are the changes in tax devolution shares recommended by the 14th and Finance Commission, and you do see some winners and losers there. And then ultimately through the grants, if I'm not wrong, it gets evened out a little bit. As for the terms of reference of the 16th Finance Commission, these are personal views. You know, my sympathies, being a macroeconomist, I call macroeconomists heartless people. We only care about growth and per capita income and efficiency. I wonder whether the current system of resource allocation should support the growth dynamism of the leading states as well. The criteria that I just showed actually, you know, favors poorer and more populous states. Internal migration is going to be a very, very important phenomenon in equalizing income and consumption levels. So how do we encourage that? How do we make it a part of the Finance Commission deliberations, a part of population? You know, the role of population and income distance will continue to favor the lagging states, but at least let's monitor and incentivize the quality of expenditure and fiscal prudence better. How do states be incentivized to reach their own revenue generation potential? There's nothing, as far as I can see, in the deliberations of the Finance Commission till date which does that. 15th Finance Commission did have 2.5% weight to that, but overall through revenue deficit grants, I don't know what we are incentivizing. And as an aside, and it's a part of the work we are doing at NCER, drivers of growth within the lagging states remain elusive. Now, this is not something that Finance Commission should consider, but it's an issue that we should have a wider discussion on. Thank you.
Thank you, Professor Gupta. I think you've covered a very substantial ground, particularly in the macroeconomy, and you've preempted us in a certain way because I had questions about how that will impact the deliberations of the Finance Commission. So we now move to Professor Chakraborty. I request you to make your opening remarks, please.
Distinguished participants on the dais, Professor Bhaskar Datta, distinguished participants of the dais, dear students, I'm delighted to be here. And I have got, I shall be very brief as my initial remarks, and I'll make only 6 points very briefly. And these issues are related to the present macroeconomic context And as we know, Finance Commission doesn't work in vacuum. So we need to really understand the kind of debates that is going on as far as center-state relation is concerned at the moment. So these are my basic ideas as far as the structure of my today's presentation is concerned. So let me first start with the vertical devolution. Now, about vertical devolution, that means the amount of money center gives to the states. That is now, as per the recommendation of the 15th Finance Commission, is 41% of center's divisible pool of taxes. And now states have been complaining that the divisible pool is coming down because as per the Constitution, cess and surcharges are not divisible, and the share of cess and surcharges in the gross tax revenue has increased. So effective devolution is around 34-35%. So you are denying me the fair share of resources. That argument, on the face of it, is a very strong argument. But let us look at the revenue, the expenditure responsibility of the center and the centrally sponsored scheme. There I would like to mention three things. One is how center spending in state subject and concurrently subjects have gone up in the last 20 years. And we did some calculations, and very robust calculation in the Finance Commission, and that was extended later when I was there in NIPFP. The center's expenditure on state list and concurrently subject has increased in the last 25 years by 20 percentage points. So center spends on central list subject only 45% of its own expenditure. So there has been a functional space which is overlapping in nature, and their center spends a lot of money. There's nothing wrong in spending this money. But if you say that I'm spending this money by imposing cess and surcharges, naturally the divisible pool would decline because divisible pool does not include cess and surcharges. So there needs to be a discussion among the center and the states. I think that's very important. It's not about we academic discussing about it. I think there has to be a national consensus about central priorities. So what should be the optimal level of central intervention in state and concurrently subjects, and what should be the optimal size of the divisible pool? So if it's a center should devise it only based on the non-divisible pool, which does not have any cess and surcharges, then 42% is 42%. In that case, the entire money will have to be financed by the non-tax revenue of the center, and center has a large revenue deficit, and the 35% of the revenue that is left after giving it to the states. So that's the space. If we are today talking about that center should finance its program through keeping the 42% as 42%, that means without cess and surcharges, this would lead to a huge macroeconomic instability because the revenue deficit of center is already 2.5% of GDP. All the grants goes to the states in the form of grants, that means revenue expenditure, center's revenue deficit will grow up. So centrally sponsored scheme is not an issue about what center should do. It's at the state level. It is an issue of macroeconomic stability. So I think it is important, now the 16th Finance Commission has been constituted, a more informed discussion is done with respect to the restructuring of CSS and the optimal allocation of money for CSS, so that fiscal autonomy versus conditionality gets a national consensus, and some resolution of that issue happens, rather than continuously talking about centrally sponsored schemes are bad but without a resolution actually is not healthy for federalism. That's the first point that I wanted to make. Second point about population criteria. I think one of the very good things about this Finance Commission's terms of reference is no reference to population. I think 1971 population, use of 1971 population for a long period of time. It was only changed during the 15th Finance Commission Award, and 14th had used it because there was no reference. There is a reference to subsequent demographic changes, which Professor Mundle referred to. So if we are actually have to assess need, and binding a commission with a population number, I think is not fair. So in that context, if we look at the terms of reference of the 16th Finance Commission, it is very fair. So Commission can decide, it has the flexibility to decide how to assess need, whether they should use population or something else, some other norm, more sophisticated norm, to understand the need across states and do an appropriate level of devolution. So that flexibility is a very important flexibility, and not at all in discussion in public space. Now, if we talk about the overall transfer is as a percentage of DB civil pool is now around 65%. And if we look at total return transfer to the states, it's around 50% of the gross revenue. So transfer that is going to the state is almost half of center's revenue. So if we are talking about further increase in devolution, so vertical devolution, the scope for increasing vertical devolution beyond what it is today is very, very limited. But horizontal discussion on horizontal devolution has taken a very, very different turn in the last couple of months, I would say. It was always there, and this has come because of redistributive nature of transfers. Now, this redistributive nature of transfer, if I may say, I think it's completely ill-informed and under-researched. Why do you say it ill-informed? I say it ill-informed because if we look at budgetary resource flow and compared with financial resource flow to states, budgetary resource flow will be a very small amount. Within the budgetary resource flow, the money that flows to the Finance Commission will be around 70%. So why are we discussing about discrimination? Because this data is readily available, where we see that Bihar gets in per capita term more than Tamil Nadu. But if we look at the financial flows, I'll just give you one very basic example. If we look at the bank credit to 6 southern states, that's 86% of total bank credit in the country. So to say that financial, so if I make a deposit in Kerala's, Tamil Nadu's credit deposit ratio is 150%, Bihar's credit deposit ratio is 45%. So money saved in Bihar, 65%, 55% of it goes back to some other states. So when we have such level of inequality in our fiscal system, where financial flows are for few states and their prosperous regions of the country, and then we say that you shouldn't be migrating because that's creating fiscal pressure on me, I think that's grossly unfair. So, but does migration not create a fiscal problem? It creates a fiscal problem. Now, to address this issue, I think Finance Commission should think of a grant which should actually give, which they should give to the richer regions of the country to deal with this large-scale migration and the pressure on the delivery of fiscal services, public services to migrant population. But to say we'll reduce redistribution to ensure that somebody is incentivized, because the incentive itself is a reward. So somebody is incentivized more. I think it will lead to more footloose migration in the country, and there will be more tension. So the kind of redistribution that we see is highly unequal, and only transfer that probably does some justice is the Finance Commission transfers. But we keep talking about Finance Commission transfer because it's available. So that's the problem of our federalism. And that creates tension, and that tension needs to be resolved through informed discussion. That's the second point. And the Finance Commission is the right platform where it can happen. Other issue that I wanted to discuss, I have talked about the 4 issues. There are 2 more issues I'll discuss. Other issue that I wanted to discuss is Finance Commission's assessment of revenues and expenditure. I think GST revenue has been buoyant, so that's a good sign. It will give a lot of revenue space to the states going forward. But there are 3 expenditure responsibilities that is not there in the Finance Commission's radar now. I don't mean Finance Commission's radar means not the 16th. I think it's not there. Is the expenditure commitments that India has made globally on climate change. What are its local implications has not been studied. So if we say our mitigation and adaptation expenditure will have to go up, and this money should be provided, and it is a national responsibility, so probably making resources available and making provisioning for expenditure that can actually mitigate climate change, improve adaptation expenditure, Finance Commission needs to develop a framework. That's the 3rd issue. 4th issue. 5th issue, I think comparability of debt and debt data. I think there is a lot of discussion happening on debt. Debt data has got, if I may use the word, non-comparable across states because of 3 things. One is 14th Finance Commission transfers, where some states were given greater power to borrow, so they were because if they performed, they fulfilled certain conditions. So the 4 conditions were there in the 14th Finance Commission's recommendations. So 6-7 states actually have continuously got those numbers. So somebody's 3% is not 3% for another state because that state has fulfilled those conditions. So second issue is the Uday debt. So Uday debt has got, because different states have different kind of debt liabilities, because their power sector liabilities are different. So some states have been doing well, so they probably did not have that much of the exposure to Uday debt, but some states which has not done really well had large exposure to Uday debt. Now when Finance Commission is making an assessment of revenue deficit, making an assessment of what should be given to the states, if this data is not comparable because of these policy interventions, I think some states who benefited because of intervention like Uday debt actually gain more because it's there, and those who have not benefited. So we will be penalizing the performing states and rewarding underperformance. Last issue that I wanted to say about the plan non-plan distinction in elimination. I think after the Planning Commission is gone, non-plan plan distinction is also eliminated. Now if we look at the revenue deficit grant, you will see the states with large revenue deficits, 2 states, I would say Kerala and West Bengal, gets almost 30 to 35% of the total revenue deficit grants. This also implies that a state which has large expenditure, that fiscal risk, large deficit in their revenue account, that fiscal risk is passed on to the rest of the country for large revenue deficit grant. So if Bihar's expenditure is low, so Bihar would not be able to get this money, but Kerala, on top of a devolution, being a high income state, would also be getting a large revenue deficit grant because we don't have a plan non-plan distinction. So in such a situation, I think it is also creating a problem of adverse incentive. And we need to really look for a solution. And the Finance Commission probably need to work on that. And finally, I think on incentive versus reward, I think if we look at past Finance Commission's recommendations, it's always a reward for past performance. So if we are talking about incentive has to be forward-looking. So if I say that your own revenue to revenue expenditure ratio improvement in the last 10 years is my incentive, it's not an incentive. You are rewarding somebody who has already done it. So if we are really talking about forward-looking incentive, conceptually we need to be clear, and that clarity probably is still not there. Thank you very much.
Thank you so much, Professor Chakraborty. I think you've provided some new perspectives to the discussion and some very telling points you've made about something that has been under discussion for a couple of weeks with regard to horizontal inequity. And I recall that in their report, the 15th Finance Commission also looked at the discussions, also looked at the demand which many of the states had then made about having a 50-50 share of the center's revenues vis-a-vis the states. And the argument that the Finance Commission had then given in the report is that if you were to look at the overall transfers and not just tax devolution, then actually it works out to 50% of the gross revenue receipts of the center. So they met the argument of the states who were feeling aggrieved by the fact that the devolution was not adequate to meet their needs through this mechanism. And I think you're endorsing that point of view with another perspective with regard to credit flows and things. So thank you for those interventions. And now we head into the discussion per se. So as I said, we begin with a brief discussion on the state of the economy. And I must thank Professor Gupta for very clearly spelling out where we are with regard to the macroeconomic parameters. The only question I have, and it's a very brief one, and you've already spoken, Professor Gupta, so I'll request the other panelists to come in on this. What are the downsides? You're looking at an award period of 5 years, which is, a bit remote from where we are today. And Professor Mundle made the point about the difficulty in correctly estimating the revenue receipts and how finance commissions in the past have always got it wrong. And they tend to overestimate revenue receipts, I think if I heard you right, because of which there are gaps in the flows. So do any of us see any downsides to our macroeconomic performance, 5 years down the line or 6? What are the risks, if I may put it across more clearly? Professor Mundle, would you?
I think the main risks are really how the external environment will evolve. Mm-hmm. We don't know. Things are very uncertain. So, I mean, whether you talk about the relationship between China and the United States, or between NATO and Russia and so on, or what's going on right now in Gaza, a lot of uncertainties over there, and how that will pan out, we don't really know. So my sense is right now everybody is trying to dial down tensions, and hopefully that will help. So that's the major risk I see. The other is, this global warming is now really gathering pace. And from everything I can see, we're going in for a period of escalated global warming, and that is also likely to have effects. But these are, if I may put it, the medium to long-term things. Over the immediate short term, again, apart from what might happen to energy prices and so on, there's of course the question of domestically of the weather. Though we are less sensitive now to monsoon than in the past, but we are still sensitive, and that drives up food prices, that drives up inflation, etc., etc. So that is an issue. So that's the real downside to me. What I'm really concerned about is now an apparent, how should I say, a disjunction between what's happening on the growth front and GDP and so on, and how that is translating into jobs for people. Mm-hmm. It's often been we have talked about this K-shaped recovery and so on. What is really happening, and I picked up a lot of this just last week at the Indian Labour Economics Conference, is that everything got disrupted with the pandemic, of course. Things which were improving got reversed. Employment was growing, formal sector jobs were growing. It was happening slowly, but happening. And there was this, Lewis-type transition of workforce out of agriculture to non-agriculture as we wanted. All that has got reversed. But the one thing that has, in a sense, quote unquote, improved is the labor force participation rate. It was going down, and now it has suddenly shot up. But where it has gone up is that with this reversal of the migration from agriculture to out of agriculture, so vast increase, it's really like a cushion, and people who don't have proper jobs have now fallen back on agriculture. Increase in self-employment. It's amazing how much self-employment has gone up. And within that, what is called unpaid self-employment. For some odd reason, the irony, everybody classifies unpaid work as employment, along with formal jobs. And I think it's a crazy thing they're doing. So you don't really know what's the situation, but the more detailed picture tells you what's going on. I mean, there's a big, there's obviously a lot of rural distress, and that we are not picking up in the macro data. So let me just stop.
Okay, thank you. So, Professor Rao, if I may turn to you now. What we're really sort of looking at when I'm asking this question is, are there any structural constraints in the economy that you see that may hit growth? Because I think what Ms. Gupta put out on the slides were actually quick macroeconomic indicators, and they're all fine. We seem to be in a good place. Constraints or structural bottlenecks, which may, over the award period, because I'm looking at not just the immediate future, but I'm looking at 2031, by when the Finance Commission recommendations sort of end. So, do you see any structural constraints coming in the way of growth or holding it back?
So I will, speak in terms of what the constraints on the Finance Commission. Basically that. It's difficult to predict what structural constraint exists. There can be shocks, and the shocks are not really, some of the shocks cannot be predicted, like the COVID type of thing. One of the things that could have been done but has not been done is to make a Finance Commission a permanent body. If you have a permanent Finance Commission, what does the Constitution Article 280 say? It simply says, President shall appoint a Finance Commission within 2 years of the commencement of the Constitution, and thereafterwards every 5 years or earlier as may be required. So you can have a Finance Commission appointed, working for 5 years, and the Secretariat will continue, and a new Finance Commission is appointed, and these people will go. You could have similar to the Planning Commission. But that was not done, because Planning Commission became much more prominent at the time. And then Finance Commission was looked upon as an evil that they have to put up with because its Constitution provides for it. Let me be very blunt on that. But if you had a permanent Finance Commission, then any changes that can happen due to structural constraint or any other constraint can be changed. But now, without that, if looking at what history has happened, the difficulty in making the projections now is not very different from the difficulty in projections earlier. 15th Finance Commission had much more serious difficulty. Now, even the 14th Finance, immediately after the 14th Finance Commission, there was demonetization. And then obviously there is a COVID issue. They had serious problems. So that's one of the reasons why they gave one report for 1 year and then the second report for 5 years. They were asked to. But now, basically what the commission is required to do is to see what would be the sustainable level of fiscal space that you have, which means that what should be the overall debt GDP, the overall debt to GDP ratio that you can have at the end of 5 years and phased out, and how much should be at the union level and how much should be at the state level, and then work out on the revenue projections, expenditure projections on both union and the states, and do the rebalancing act. Basically that is the way they will have to go about. So it's not the uncertainty and this thing is not very different for this commission as compared to the past. Possibly they have a better thing because GST has stabilized. And with that, you have thanks to both of you, you have a very buoyant revenue, tax revenue. Tax revenue buoyancy has significantly improved last year. Both, income tax, because there can be a comparison of the income tax turnover income tax revenue, this thing with the GST turnover. But anyway, now I think the public finances of at the union level have stabilized. At the state level, most of the states have done well. In fact, when all is said and done, I think one of the best states in terms of financial management is Orissa. I mean, if you really look at it, the interest payment to revenue ratio is just about 7%. Their fiscal and public, their debt to GSDP ratio is less than 10%. So, I mean, they have managed to do it, with all the incentives that you have. But so now I don't think there are any. So, the short answer is that I don't think there will be any structural constraint this Finance Commission will be faced with.
Thank you. Actually, let me put it another way, because maybe I'm not making much. The point is that the Finance Commission's recommendations are based on what goes on in the macroeconomy. And the size of the divisible pool, your tax revenues, and your expenditures are obviously dependent on how the economy is doing. Now, currently, everything looks fine. And as Ms. Gupta pointed out, God is in his heaven, the economy is doing well. We're firing from all cylinders, every which way you look at it. And it's very difficult for her, as she admitted, to even look at 2 or 3 negatives and put them up on the slide. What I'm looking at is a more long-term thing. So I'll tell you what I have in mind. So is it that we would be held back in our growth as an economy by virtue of the fact that we're not able to reap the benefit of the demographic dividend, for example? I mean, the skill sets, education outcomes, those kind of things. Is it that our inability to pull people out of agriculture is going to be a constraint within this period of 5 to 6 years that we're looking at? So any thoughts on that, Professor Chakraborty? You want to come in?
Yeah, a couple of things, I think, as far as macroeconomic uncertainty and growth is concerned. I think one issue is decline in savings, financial savings. Now, 12th Finance Commission had given this argument where at that time the ratio of financial saving was something like 11% of GDP. And 12th Finance Commission had said that 5% of GDP is the private sector's. Private sector actually takes around 5% of GDP from there. So 6% is the government deficit. Now, this argument is fundamentally wrong. Wrong in the sense, then we are talking about a pro-cyclical fiscal policy. That means when my saving is more, I can borrow more, but you are giving a counter-cyclical measure. Now, so that was at a time when economy was growing at the rate of 8-10%. So nobody questioned it. Now we are in a situation where we have a low savings and center's deficit is 4.5. That center wants to achieve by 25-26, and then states together has a fiscal deficit which is around 3.5, which is again higher than 3, and then large revenue deficit even at the state level for big states. Now this is a major risk because 62% of the capital expenditure is at the state level. Now, if 62% of the capital expenditure is reduced because of rising revenue deficit of the states, where we are talking about transfers, freebies, etc. and all. So the quality of revenue expenditure at the state level has gone down. Investment is not picking up. And savings rates, financial saving rates have declined. That is a major concern that Finance Commission will have to assess and project growth. And growth assumption is critical for any work that Finance Commission does. Because budget is in nominal term. So if we are assuming a 13.5% GDP growth rate, after 5 years of projection with a revenue buoyancy of 1.1, 1.2, 1.25, everybody will be in surplus. It will look very rosy. But the point is, if it is quite off the mark, the actual reality, then probably we will have a situation of large debt and large deficits, because we have second macroeconomic risk that I see is high level of public debt. So we are talking about bringing it down to 60%. Now we are at 81%. So I think there has to be a credible framework by the Finance Commission that needs to that the GDP ratio by 2030 should be reduced to at least 75% of GDP. That's the second thing. Now this 75% GDP is not going to happen at the state level because states have really contracted in terms of their total expenditure, and state debt to GDP ratio has declined from 33 to 27% after COVID. So states have made significant correction. Center also has made significant correction. But when it comes to debt, center's debt is around 70% of the total debt of the country. So center has to make a larger correction as far as the debt ratios is concerned. So I've written a paper recently which has just got published. So my submission here would be for that instead of targeting fiscal deficit, since we are going through an uncertain economic environment, let's target two things. Let's target revenue deficit, so that we are going to reduce revenue deficit in the next 5 years in this manner, so that you don't have that risk of increasing, transfer payments, etc., subsidies, etc. At the same time, it will ensure that you don't have a cap on fiscal deficit, but your debt ratios are monitored. So an FRBM framework like this could give necessary flexibility, yet reduce the macroeconomic risks from the fiscal side. Second issue, recently there is a paper by IMF. So recently there is a paper by IMF which actually said the global debt to GDP ratio is now 269%, which includes private sector debt, non-financial private corporate debt, household debt, and public sector debt. India household debt is low, but it is increasing. Because our financial saving has declined, liabilities have gone up by 2 percentage points of GDP. So it is very important to show recent RBI measures about controlling banks, imposing higher level of regulation. I think it's coming from that perspective. So these are the risks. How Finance Commission accounts for this risk and calculate growth, which is the parameter to create all other numbers, will be extremely important. And I think a growth beyond 12% at this stage in nominal term would be very difficult to justify, because Finance Commission also will have to justify these numbers. I think these are certain issues that I think is extremely important.
Thank you. And that brings me to the question of the fiscal health. And I think you've already sort of talked about it. As did, your opening remarks. I think almost all the speakers have mentioned. Professor Rao mentioned how the degrees of freedom are limited because of certain factors. You've talked about the growth in debt to GDP ratio. Although there is a counter view to the debt to GDP ratio, which is that it's a very blunt instrument of monitoring debt. And perhaps a better indicator is the FRBM targets. I'm not getting into that, but that's just a view. It's not my view. It's a view which you come across in literature. So the other thing is that when I look at the debt to GDP ratio in the context of the 15th Finance Commission, if you recall, they had done a scenario building of three types. One, if the economy recovers, at a pace better than what they had projected, and one lower and one higher. Now, what I find is that they had perhaps projected that the debt to GDP ratio is likely to come down to about 88% or 85% or nearabouts, in case the economy, doesn't do as well as they had projected it to be. I was looking at the IMF Fiscal Monitor, and to my surprise, I found that in October of 23, our debt to GDP ratio, according to them, was already 81 or 82%. Now, there could be a conceptual difference. I don't know. I mean, how they define debt to GDP, how they understand debt. There could be some definitional issues. I'm not sure of that. But if that is so, then is it really that big a risk? I mean, I'm just flagging this because this is something that I came across. So any views on that, Professor Rao, would you like to?
I don't think they took into account the entire impact of the COVID. Mm-hmm. Because they were still writing the report. So the actually debt to GDP ratio rose much higher than what they had projected. And from there, so those projections really lose a lot of, sort of realism because of that particular thing. Because they were actually working in difficult times. That's and the impact of some of the things like extension of food subsidy and various other things at the center. The impact had continued, sort of for almost 2 years.
Yeah.
So, but then they also make a very clear statement that after the things settle down, you need to really rework the entire, sort of debt sustainability, this thing, and rework the targets. And, they make that statement, but that has not been done.
Okay.
In fact, they themselves are not sure. First of all, that is the reason why they give 3 scenarios. And then at the end, so one of the scenarios give them the 4.5% of fiscal deficit, this thing. The government of India has just picked up that 4.5%, and, the finance minister made a statement that they will stick to that. But the basic point is that, you can do that with fiscal deficit, but debt is a stock. It takes, So my own this thing is that we do need to rework the entire thing in the new scenario. And that is the reason why this Finance Commission will have to do it, even though it has not been asked to work on the debt sustainability issue. They will have what is the fiscal space that is available for distribution has to be worked out, keeping in view the sustainable levels of debt.
Thank you. Yeah, sure.
So 2 things on your growth question very, very quickly. So what are the risks? These are tail risks. If multiple shocks occur at the same time, that can impact GDP growth. What I was showing was one shock at a time, right? So if you have monsoon failure, terms of trade shock, along with something else, then that can impact. But it's a tail risk. So how does the Finance Commission prepare for it? Very, very hard. Maybe better escape clauses, maybe better buffers. I think that's what any agency can do in the business of projecting growth rates. On public debt to GDP ratio and IMF numbers versus the Finance Commission, as you rightly said, debt to GDP ratio is a stock in the numerator, a flow in the denominator. The ratio changes a whole lot because of the denominator as well. So recovery after COVID was surprisingly high and rapid. And that perhaps brought out the decline in debt to GDP ratio better than what the Finance Commission had assumed. IMF's definition usually is a broader one. They usually give numbers higher than the national numbers because they bring below the line items, above the line, and so on. They include contingent liabilities better. So I would go with the IMF's number that it's perhaps close to 81, 82, which means decline from 90 to 81 to 82 has happened as much because of the denominator as due to the numerator. And but bringing it down to 60 is unlikely to happen. So what is the new number that we become comfortable with? I think that's the question.
So that is the point which Professor Rao is making, I think, saying that the 16th will have to rework, these ratios and come up with their own estimates. So of course there are a lot of issues around the vertical imbalance, and if I heard Professor Chakraborty right, I think you're of the view that there is just no scope for increasing devolution, tax devolution further. Very quickly, is that the view of the panel? Does everybody agree that? You agree with that, Professor Rao? I think you also said that there's no room for increasing devolution, tax devolution further.
I have a slightly different view. I'll tell you why. I think that, there may not be room for increasing transfers. In the sense that, you talked about the 50% of the gross revenue. There may not be at this particular point of time. Later, I don't know. But certainly there is a need for rationalizing and cutting down the centrally sponsored schemes.
Mhm.
The reason why I say that none of these schemes is properly designed. If you're saying that specific purpose transfer is for ensuring a minimum standard of service, for meritorious services, you are not able to give, general purpose transfer through the Finance Commission, you are not able to enable every state to provide a given level of public service. But at least there are things like education, healthcare, water supply, and even anti-poverty interventions. Take 3 or 4, but then make sufficient allocation to these so that minimum standards are maintained throughout the country. If you are not able to take capital to the people, take people to the capital. And that means human development is a critical element in the thing. So try to work sufficiently, in many of these places like whether UP or Bihar or Odisha, if you do the human development thing, they will find their job somewhere and they'll go. And you don't really, or they may work there itself, increase the productivity. Ultimately, you need to increase the productivity of the people. Now, specific purpose transfer is meant for that, not on, so you had 240 schemes, which were compressed into 66 by the UPA government, and here comes Niti Aayog committee, which makes it into 28. And all the 240 schemes are there in these 28. They're all umbrella schemes. No, you can't be, so you can't do anything. In fact, 4 or 5 schemes constitute 70% of the transfers. And why don't you just focus on 5 of them and, ensure that properly design them to ensure a minimum standard. Now, if you do, so if that has to be done, or, the amount of money that you spend on specific purpose transfers will be less because you don't spread so much of money for the bureaucracy. Because each one of them has a huge amount of bureaucracy. Number 2, tax devolution can, go up, as Pinaki said, union government encroachment on the state subjects. In the Finance Commission, we said it was from 14% to 20% during the period 2005 to 2011-12. That was the increase. That, let this, if it is in the state subject, let states decide how they want to spend. Possibly, so I would say that overall transfer may not be increased, but at the same time, you need to really rationalize your centrally sponsored schemes. And that was one of the reasons why the 14th Finance Commission gave 42% tax devolution, saying that you cut down on the centrally sponsored schemes. They cut it down in the first year. They did it in the second year also. Then what happened is that, they started increasing the cesses and surcharges, got the money, more money, and then brought back to the original level. And that's where the problem. That's where I have the problem.
Okay, I think we're heading towards close of time. So we do need to sort of accommodate some questions from the floor, and I think now's the time. So if any of you have questions, maybe you can take 3 or 4 quick questions. Yeah, please identify yourself and you can ask the question.
So I just want to kind of take on. Thank you. So I just want to kind of take this central sponsored schemes and kind of give it a slightly long-term twist on it. So if you think that kind of there are certain structural challenges in the nature of, say, automation, global warming and its impact on agriculture, inequality, and all of this kind of seems to suggest that some kind of, as we go ahead, some kind of unconditional transfer in the nature of a basic income, whether it's universal or not, might kind of be in the play at some point in the future as a very serious policy option. So now if something like that happens, I was just wondering how should we conceptually think, and of course, kind of if it's a basic income, then it will be kind of a central sponsor scheme, right? How should we conceptually think of such a scheme in the context of center-state federal relationships and this whole issue of kind of how transfers or the notion of transfers should be handled?
Your question is to a particular person in the panel, or you're happy?
Yeah, just.
We both have passed. So.
Professor Mundle?
Yeah, you know, I thought actually Govinda was moving in that direction, didn't quite. You know, these centrally sponsored schemes are ad hoc schemes taken on by various ministries, departments, and so on. They're not subject to any discipline, as it were. Now, I said, I think the 41% is about as far as you can go. It was actually 42 because JNK became Union Territory, they reduced to 41. But in between, there are these grants that the Finance Commission also gives. Now, those are, you know, in my view, much less ad hoc. So many of the things that are being addressed now through centrally sponsored schemes, if these are indeed issues which have externalities and they spill across state boundaries and need to be dealt with by the center, it can also, I mean, the Finance Commission can always recommend grants as an approach to dealing with some of these critical issues which are at the moment being handled through centrally sponsored schemes. And there was really no reduction, as Govinda was mentioning. The number, they just started compressing, and so it appeared, it was purely an optical thing that the centrally sponsored schemes had been squeezed. But in fact, the reality is that they hadn't really been squeezed, and half a dozen of them take up most of the money. Most of, you know, all the rest are really little things, and you can just wind them up.
I'll just add, as I said, I haven't understood your question, but nevertheless, finance commissions can give purpose-specific grants, which is not that they cannot give. But the problem is, in fact, in the past, some of the finance commissions have given. But the problem is they can't monitor this. You know, because they are a temporary body, they just give the grant and they just, you know, they go away. And obviously, even matching part of it also is not being given. So obviously, you know, if you simply say that this money is for education, the states will substitute their own expenditure to that particular this thing and they'll put the money wherever they want. So it doesn't really work, you know, so in that sense of the term. The specific purpose grants are required, but then not the way it is being done. You know, I mean, they're required if you really want to establish and ensure a minimum standard of, you know, basic meritorious services. This is required, but then, you know, you can't have so many meritorious services.
So I think Professor Rahul's question is about universal basic income, and is that a superior solution to centrally sponsored schemes? I think that's the way I picked it up.
Yeah, so
but
if it's a universal basic income, something of that nature, so that has to be a central government, out of the central government's pool, right?
Yeah.
So now how do you kind of position that or put that in the context of sharing resources between the center and the state?
Okay, I'm afraid we'll just have to move on to the next question. Yeah, the lady there, please.
Hi, my name is Akshi. So my question is on the, the role of the population numbers. So it's just an open question to everyone as to what would your ideal solution to this be? Because it's a contested question for sure. And I wanted to complicate this a little more. Of course, there's one thing about the number of people in each state that obviously penalizes states that have brought down their population. So you sort of weigh in the total fertility. But then there are also states which are going to see a very huge amount of aging population. It's already happened. There's southern states, there's Punjab. Right now, these will not have working age populations. And these are states which have probably done better now, but will possibly need migrant labor to come in or rethink their own economic strategies. So against this background, and again, we don't even know the real population numbers right now, how much they've changed in the last decade. So this is a wish list question to any of you. If you were to actually address this question, for the 16th Finance Commission, how would you like to address this?
What is the question?
Can I request
how do you address population
thank
better?
you for this very interesting question. I think finance commissions were tied to a population number. This is the first finance commission which has not been asked to use a particular reference population. So finance commission has a flexibility. And if we do a thought exercise, and if we say that finance commission is assessing need of states for the next 5 years, and if it is, I'm not saying it's the right way to do to assess need. If we say that per capita is the need, so everybody should have the same level of per capita expense, just for thought exercise. So in that case, the finance commission should use, I'm not saying that it's going to happen, finance commission should use mid-year projection of 28, 29 to assess this need, rather than going back to 2011 population, because that is 20 years old. So I think not giving population reference to the finance commission was a good thing and that has happened for this commission. That is one aspect. Second aspect is, how do we assess need? Do we really require population to assess need, or is there some other sophisticated method of assessing needs? I think our commissions have used population data, and for all practical purposes, it will always be useful to be non-controversial. Use 2011 population. And my guess is Finance Commission will be using 2011 population. I don't know.
Can I add to that? Yeah. Actually, you partly answered your question yourself. Looking at just not the numbers, but also their diverse needs. You mentioned aging people, migration we have talked about, but also the SC/ST population perhaps, right? People who really need more help from the state than otherwise. So a richer measure of population, I think, would be better than what we have currently.
Let me just answer a question in a different manner. Finance Commission is not a population control commission.
True.
Incentives?
No, you have other instruments. You can't be using a transfer formula for controlling population and giving a reference that use the 1971 population or 2011 population is basically, it's anarchic. I mean, you can't be, Finance Commission, what is it that is supposed to give? Enabling the state to provide given of services. Services to whom? Services to the current population, not the 1971 population. And so obviously now that they don't have that constraint in this commission, that they have not been asked to use any particular population figure. It's up to them to do, to choose how they want to go about. And as far as aging population and this and that is considered, if you are estimating an expenditure need, as we did it in the 9th Finance Commission, and what is the average cost of providing a, sort of healthcare service or public service, then you can actually use, we did use the regression equations where we put in all these variables and then estimated the expenditure need. So that can be done, but then finance commissions, when we did that, one of the members of the commission wrote a note of dissent saying that he doesn't take a normative approach. And his comment was, these people, in order to estimate this, they are using variables. They are using variables. They are using proxies. And how can you take it? This is a member's note of dissent, if you really see that. So
you mentioned 9th Finance Commission. Hopefully things have changed.
No. The point is, so obviously, in the Finance Commission, you have got to be careful about using any techniques.
But I think the time for these ideas has come, and the Finance Commission may need to look at some of these, parameters. Yeah, the last question.
There are three of them.
Okay, very quick. And please be brief in your question.
Yeah, sure. Hi, I'm Shubhashri. I work at NCAER. I wanted to ask specifically regarding the fiscal targets, which the Finance Commission also has great influence on to provide for the states. I want to understand what logic goes behind defining the number exactly. It says 3% for some years, 3.5% for some years when there is, say, some sort of economic shock to the economy. And during COVID, it was 5%. But my question is, during COVID, even if states required more assistance, the incentive to get higher enhanced fiscal space was based more on, say, power sector reforms or others, which are not directly related to the kind of shock which the states are experiencing. But still, what is the logic that it's only 3% generally? Why is it not 2%? Why is it not 4%? I'm just trying to understand because I'm very new to it. And just secondly, because Dr. Rao, you also mentioned that we need more tighter fiscal targets. Would possibly these tighter fiscal targets, can we have some sort of, given the heterogeneity of the states in India, could it be that generally these targets, if they are reformed, can they be implemented taking into the heterogeneity of states, and these can be different for different states when the Finance Commission is advising and providing them? Thank you.
Okay. Anybody else? One last question, and we can take it together. Yeah, please go ahead.
Hi, I'm Uday from Ashoka University. I'm a first year. So I wanted to ask you about the impact of rainfall and the shrinking piece of the pie that agriculture now has in the GDP. So I interpreted that as, so the scant rainfall means that climate change now has a bigger impact than ever on the economy. However, since the share of agriculture is shrinking in the GDP, it also makes sense to deprioritize growth in agriculture. Since rainfall has less of an impact, does that mean that the growing impact of climate change is less of a priority for the Finance Commission? And since Professor Chakraborty talked about how climate change is necessarily a long-term or a medium-term issue and not a short-term issue that they necessarily have to address in the next 5 years.
Thanks. Yeah, the last one.
Hi, my name is Rajat and I'm from CSEP. I have a simple question. I have the question regarding when we talk about Finance Commission, and since its role is to correct imbalances will also be created due to the shift towards energy transition, although not immediately, but will be there. And because if it is going to be there, and since forests, there were grants given from 12th Finance Commission for the forest conservation, and then slowly it moved on to the assignment of the weights, can similar technique also be used for this fiscal imbalances which will be created due to the shift towards the energy transition as a move?
Thanks. Would you like to answer any of the questions?
Can I start?
Go ahead.
Yeah. Now, I'll just talk about the target. Now, see, this target came from the 12th Finance Commission. At that time, I mean, any target that you want to do is there is a certain amount of arbitrariness. I mean, let us take it. But what they did was they tried to look at the household sector financial savings, because if you have households, corporates, and government. Now, if you see the savings investment balance, obviously the government borrows. There is no positive saving there. Household and corporates also need to borrow. So borrowing space exists only in the household sector savings. Within that, household sector financial savings. Household sector financial saving at that time was about 10% of GDP. And then, current account imbalance, deficit, that means money coming from abroad, was about 1.5% of GDP. If you keep 1.5% for the public enterprises borrowing, you are left with 10%. Out of that, if you keep 4% for the private sector, corporate sector of the private businesses to borrow, you are left with 6% of GDP. So the commission said 3% for the union government, 3% for the state governments. This was the logic that was used, and many people misinterpreted, saying that, oh, this is a massive treaty thing, they have simply copied. But basically, there are 2-3 pages of write-up in the 12th Finance Commission report which tells you this. That's one of the reasons why I said now that the household sector financial saving has come down to 5%, 5.1%, we may have to rework the thing. No, that's the basic point. Yeah, I mean, you see, if you don't do this, what happens is that the money, if you give higher deposit, money available to the businesses will be less, and obviously interest rates on that will go up, and then that will have, that will create problem for the, for them to borrow for the investment. That's the one. Now on the environmental thing, what happens is that the Finance Commission doesn't make policies. It asks the union government as well as the state governments to make projections of their revenues and expenditures. It is the union government and the state government which have to take into account what sort of environmental policy for net zero they have to take, and then make the projection and give. And then they will ask what these projections are. Then they scrutinize these projections, and then see how many of them are legitimate, how many of them are not legitimate, and then make their assessment. So the Finance Commission doesn't make any policies, or doesn't tell anybody, anybody that you need to make these policies.
Thank you. Anything about energy?
His question on agriculture was not addressed. Let me just say, it would be absolutely wrong to think that agriculture should have a lower priority, because while its share of GDP has gone down, it still carries the entire load on the workforce side. And as I was trying to explain, there's this increasing distress over there. There are important policies to reduce the reliance on water-intensive crops like rice and sugarcane and wheat and so on. But that's not for the Finance Commission. I mean, the agricultural policy is a different domain, and there are lots to be done there. On the energy transition, I think Govinda already touched on it, but this is a very, very big issue. And it's a global issue. It's not something, again, that just the Finance Commission can deal with. But to the extent the Finance Commission is involved with it, if there are state-specific costs of the energy transition, that is something it can address through specific purpose grants.
And although as a moderator, I'm not supposed to respond to questions, but I'm tempted to on energy transition. I've also wondered why the Finance Commission cannot incentivize by using a parameter of, let's say, investment in renewables. And that's a very easily measurable parameter. State-wise, you can get that number. And that could be a spur for getting states to sort of invest more in renewable energy. And they could get some grants based on that. Anyway, I think we've really run out of time. Vikas has been looking at me very, very nervously for the last 10 minutes. So may I request you, Vikas, to...
Thank you so much. I mean, all is left is well, thank you both the chair as well as the panelists for this both lively and then really insightful conversation, and then just give our token of appreciation. And so I'm going to request our academic director to just hand over small Ashoka gifts, maybe starting from Professor Dr. Rao. Well, I do have to say 2-3 special thanks. I mean, thank you, Dr. Rao, for traveling from Bangalore for this. Really appreciate it. Thank you for chairing this. This has been such a fantastic job. And then from the Ashoka side, really thank you, Ashoka X team. They have been fantastic in helping all of this. Thank you so much.
Thank you all for coming. And on behalf of all of us here, I also want to thank Vikas, who's been the man behind the scenes, and he's really put together this whole thing. Thank you. And please join us for tea outside.